Hello, this is Amaka Ifebunando, the Excel coach, and in this tutorial, I'll be showing you how to build a three-statement model in Excel using a case scenario. Right, so we'll be looking at a case study and I'll be walking you through. So I'll advise you to get your laptop, get your desktop, and let's walk along. Right, so here is a case scenario we'll be working with, and we're looking at a company that just started out in 2024, Amaka Global Foundation, in short, AGF. So AGF is a business that started operation in 2024. So I'll be looking at the case study. It's a PDF file alongside with the Excel workbook we'll be using to design the three-statement model. So we have the case study here. Let's read through the case study, then we get to the Excel file and start working on it. So AGF is a business that started operation in 2024. The business is into the production and sale of fresh juice. You have been provided with historical balance sheet as at 31st December 2024. Your task is to build a long-range plan for AGF for the next 5 years. That's 2025 through to 2029 using the balance sheet historical data and the assumption outlined ahead. Assume all figures are in Nigerian Naira unless otherwise stated. Now, for our revenue assumption, we have AGF targeted sales volume in the year 2025 is 1,000 units and expected to grow by 3% annually. The targeted selling price per unit is 500 Naira and in the year 2025 and is expected to grow by 2% annually. AGF offers training service to students on how to produce fresh juice. The planned revenue from this training is in 2025 is 150,000 and it's expected to grow at 2% annually. So we're going to read through all this, but we're going to be taking it one after the other and we're going to be outlining it. Now, I want you to understand something. When you're going to be working, when you're working with a case scenario like this, first of all, you pick all the assumption and pick out all the necessary details that you need in order to build this model. So we're taking it one after the other. But before we start, let's look at the structure of our model in the Excel workbook. So as I stated, I placed it side by side so that we can just have easy manipulation between the PDF file and the Excel workbook. So the first sheet here is the income statement. As you can see, we have Amaka Global Foundation, AGF, three-statement financial model for 5 years period, 2024 to 2025. So we have this I'll call this, we're looking at this is more like our report or a summary to see how the gross profit margin increased over the years and the net income. So we're going to be inputting formulas here and to get those metrics here. So this is the income statement. This is the forecast because the business started in 2024. It's still a new business and definitely we have just the financial statement. That's the statement of financial position, the balance sheet balances as at 31st December 2024, as we can see in the case study. So here we are building a 5-year financial model. So with those information, we're going to be building the income statement. As you can see, we've structured it here. So I'll be dropping this file for you to work along. Then next is the balance sheet. This is the balance sheet. As stated, this is the historical data of the balance sheet. These are the historical data, and you can see it is coded in financial modeling. When you for hard coded figures, you put it in a blue font color. Yes, that's one of the standard. So when you see a value in a cell with a blue font color, you know that it's hard coded, meaning that it's an assumption. There's no calculation in that. You know, it's something you assume and feel that okay, these are figures that is not generated by doing any calculation. They are hard-coded figure. Just to state that for you to understand. So this column here is the historical column. So because the balance sheet we have is just for 2024, which we require to build the financial model. Then we now have the forecast columns from 2025 through to 2029. All right. Then you now have the cash flow. Mind you, it's a three-statement model, and the three-statement model include the income statement, the balance sheet, and the cash flow statement. So you'll notice that it all has the same heading, and also the 2025 started from column D. You can see the consistency. I want us to notice that 2025 started from column D, not minding that the balance sheet has column C for historical, but we ensure that column D all through are 2025. right? So we have the cash flow statement, it has been structured, right? Then we now have the assumption sheets. Now, this is where we're going to be putting our assumption as we read through. I think I still have some of the assumption here. Let me just remove this. I will still impute it. So let me just remove this so that we all go through it together. So this is where we're going to impute all our assumptions. Then this is a schedule. This schedule is where you'll be doing your calculation. After you calculate, then you now impute it into your financial statement where relevant. So I needed to take you through the sheets. We have 5 sheets in this model that we're going to be working with, right? The 3 statements, the 3 financial statement, the income statement, the balance sheet, and the cash flow statement. Then our assumption sheet and the schedule where we do our computation. And notice that it is all structured in the same format so that as we're picking figures, we won't miss one year figure to another. So this is something I needed to state before we go in. So the first thing we'll do is to get our assumptions. So we'll go to the assumption sheet. The first assumption we're reading, as we've read the first set of the case study, and the first assumption said we are building a statement, a financial model from 5 years, from 2025 through to 2029. Now, it says AGF targeted sales volume in the year 2025 is 1,000 units. Now, it says the volume of juice targeted in units. So this is the volume of juice targeted. That's the volume we tend to sell. In 2025, it says it's 1,000. So you just put your 1,000. I've already formatted this, putting the necessary format that is required. As I told you, this is hard coded because these are assumptions. There's no formula in it, right? So it says that the and expected to grow by 3%. So if the sales volume in the year 2025 is 1,000 units and is expected to grow by what? By 3%. So what is the volume growth rate? We'll come to this place where we have the volume growth rate, as you can see. It's expected to grow, meaning that subsequently it will be growing at 3%. So we'll put the 3%, then you just copy through to the right, right? So Control R. Just a minute, let's so Control R. It's not moving, so maybe I just use the copy downwards and fill it. So I don't know why it's not moving. So let's go ahead. The targeted selling price per unit is 500 Naira in the year 2025. So we pick that one. Targeted selling price per unit is 500. So you put your 500 here, right? So what it says again is that and expected to grow by 2% annually. So selling price is expected to grow by 2%. So meaning that in 2025 it's 500 Naira we are targeting to sell, but subsequently it will be growing at 2% based on the previous selling price. So put the 2%. As I stated, I have formatted that. So you can copy. I don't know why my copy Control R is supposed to copy to the right. So I don't know why it's not copying, but you can just select and copy downwards. All right. So let's continue. So it says AGF offers training service to students on how to produce fresh juice. Now, the planned revenue from this training is in 2025 is 150,000 naira and is expected to grow at 2% annually. So the core revenue, because you will notice that they say the business is into the production and sales of fresh juice. So this is more like an auxiliary revenue, another section of the business, not really the main, but another part of it. Maybe they offer by the side of the business, maybe doing training for persons that are interested to build a capacity. This is what AGF offers. It offers student service, and the planned revenue from this training in 2025 is 150,000. So, and is expected to grow 2%. Now, the selling price growth rate is 2%, and the auxiliary, so I'll still use this 2% for both the selling price and the auxiliary. So this is 150,000 in 2025. So, and is expected to grow by 2%. So let's have that in mind. So we are done with revenue assumptions. Let's move to the next assumption, which is cost of sales. It says the raw material cost is 20% of revenue. The packaging cost is 5%. So raw material is 20% of revenue. So we'll just put the 20%. Packaging is what? 5%, right? So we'll just copy it to the right. We'll just copy it to the right. I don't know why my shortcut is not working. So you can use Control R for that, but mine is not working. I'll just drag it to the right, right? So that is it. We've picked the assumption for that. So let's go down. The next is operating expenses assumption. Personnel cost is 10% of revenue, marketing cost is 3% of revenue, and SG&A, that is selling, general and admin cost, is 2% of revenue. So we put 10% here. Here is 3%, and this is 2%. So just copy to the right. Copy to the right. So you can see how we are picking the we're picking all the assumptions, right? So it's going to be increasing at that rate, right? So the next assumption is company tax at 20%. So our company tax is 20%. So you just put your 20% and copy to the right. So just Control V, good. So we move, we move. So the next is working capital assumption. See, based on historical data, it says make reasonable assumption for computing working capital lines. Revenue for the year 2024 is 300,000, and the cost of goods sold in 2024. So mind you, the detail we have on this workbook is the balance sheet balance for 2024. But for us to compute working capital, we need the revenue and cost of capital, and it's being made available for us. So we have to impute it, and it's for 2024. Mind you, I say column C is 2024. So we impute the revenue for 2024, which is 300,000 is in Naira, and the cost of goods is sold is 90,000 Naira. All right. So this is what we use to compute our working capital. So this is the available assumptions we have in the case study for working capital. So let's move down. Let's just pick all the assumptions, then we just go ahead. So now we are in this section, which is capex assumption, which is the fixed assets and depreciation. Now it says AGF is expected to spend 80,000 in 2025 on the purchase of refrigerator and 65,000 naira for the purchase of juicer machine. Mind you, this business is into the production and sales of fresh juice. So AGF is expected to spend 80,000 in 2025. So remember, our column for 2025 is column D. So you can even freeze so that you can be seeing it. So right, for easy scrolling. So for AGF, we have an existing assets. Our existing assets useful life. So when we go down there, we'll get it. But for now, we say AGF is expected to spend 80,000 in 2025 on refrigerator. So 2025 is column D. So it's expected to spend 80,000 on refrigerator and 65,000 on juicer machine. So we've gotten this for the purchase of juicer machine. Then the useful life for the refrigerator is 10 years. So we have useful life here. So you can put 10 years here. And that of the juicer machine is 5 years. Good. So it says AGF uses a straight line method of depreciation. We'll just note that. Existing tangible assets have a useful life. So the existing tangible assets has a useful life of 4 years. So we need that. So we already have an asset. When you go to your balance sheet, you notice that there is a fixed asset here. So there's already an existing asset as at 2024 with a net book value of 32,000. Right. So that asset has a remaining useful life of 4 years. So we need to note that. So it says depreciation expense is included in a separate line on the income statement. As you can see, if you look at the income statement, depreciation expense is in a separate line. We have depreciation and amortization. So it's telling us that that expense is included on a separate line on the income statement and not included on cost of sale or SG&A. So we don't include depreciation. We should not include it on cost of sales or SG&A. It has a separate line. So we note that. So that's the assumption we need for capex. That's our fixed assets and depreciation. So the next assumption is debt assumption. That's debt assumption. So it says AGF plans to obtain a new loan of 300,000 in 2027. So new loan in 2027, that's column F. So this is 300,000. I believe this is column F, yeah, 2027. Right. So it says repayment for existing debt is 10,000. So we have already an existing debt. So if you go to your balance sheet, go to non-current liability, you will notice we have an existing debt. And it says repayment for that existing debt is worth 10,000 yearly. And while for new debt is 30,000 yearly. So repayment, meaning that from this year we're going to be repaying 10,000. Then the next year too, I think is the same, is the same. I want to move this and control R. So my controller is not working here. I don't know why. So I'll just put 10,000 here. Okay. So sorry, I'll have to copy. It has to be blue coded. So then it says that because we are making a new borrowing in this year, so repayment is at the end. So definitely we need to take into consideration because we already have an existing we are going to be in. So we take into consideration, meaning that 10,000 plus 30,000. So it's going to be 40,000. So we're paying 40,000 here, right? So subsequently it's going to be 40,000. So let me just copy and here we paste and that's it. So we've captured for that. So it says interest rate is 7% annually. So we'll just put our 7%, 7%. Let me just copy and here we go and we paste it. Good. So that is it for that. So it says equity. There was no new issue or repurchase of common shares. That's ordinary shares. So there was no new issue, there was no repurchase. So meaning that what we have on the balance sheet as equity, ordinary shares, remains the same all through the 5 years period we are forecasting. So there was no new issue. There's not going to be any repurchase. So what we have issued in 2024 is the same thing. So keep carrying the balance forward. Right. So I believe we've captured all the assumption required. Right. So maybe I should just close this. Okay, let's read that requirement. It says, using the spreadsheet provided and the information in this case, build a financial model that forecasts the company's financial statement annually for the next 5 years. Create assumption section to enter your input. Ensure the assumption section is logical and well organized. As you can see, we've organized it, right? So I'll just let me expand this so that we can have a better view. Great. So let's expand it. If we need to look at the case study too, we can go. So basically, this is what we have. So first of all, the first assumption we have here is revenue, and these are the details. So we're going to be computing the revenue for the period of the forecast. So go to the schedule. We have revenue computation. So our core revenue, the sales volume. Remember, we have our assumptions. So the sales volume, we'll pick the volume we have at the assumption. So we'll just go up the sheets and here we go. So this is the assumption we have for 2025 for sales volume 1,000. So this is the sales volume and the selling price. We pick the assumption. So just watch the way I'm moving to the sheet. So you go pick it because we are picking it from the assumption. Now, this is the sales volume we have been informed that we'll be making in 2025, and this is the selling price. And from the assumption, remember, we have growth rate for sales volume. So we have to compute the growth rate in considering the growth rate to forecast for 2026 through to 2029. So to do that, you select the cell, that's the previous sales volume times, you open the bracket, 1 plus the growth rate. And what is the growth rate? You go back to your assumption sheet. And remember, the growth rate is, always learn to use your keyboard, it's faster. So you now close the bracket. This is the growth rate for sales volume. And always be sure you pick the right cell. And when you need to use the either relative or absolute cell reference so that you can just copy the formula through, please just make use of it. So for now, I think for relative cell is okay for me on this, so I can just copy Control R, right? So I don't know why my Control R, is it because I'm recording? I don't know. Okay, so the next one is the sales volume is by 2%. So we say this times, open the bracket, 1 plus, so you go back to your assumption sheets. Remember your selling price growth rate. So we'll pick it. This is the selling price growth rate, and you're there. So you can see it's going to increase by 510. So that's what will be happening all through. So I'll just copy and I'll paste it here, and that's it. All right. So you can see the growth rate 1000 at 3%. I think it's 3%, right? 3% and 2%. So you can see the sales volume is growing at 3%, the selling price is at 2%. So now the total core revenue definitely is sales volume times selling price, right? So you see equals to this times the selling price, right? So you can see your sales volume times the selling price, you get your total core revenue. So I'll just copy this, Control C and Control V. All right. So this is our core revenue. Mind you, we are working with the assumption we've already captured. Now, remember the auxiliary revenue. We'll have to go back and pick it from the assumption. So this is the auxiliary revenue. And auxiliary revenue is going to be increasing by 2%. If you remember, I told you that to note that. So it will be increasing by 2%. So you pick this and times, open the bracket, so it will increase by 1 plus the 2%. So you go back to your assumption sheet and pick the growth rate for selling price, which is the same thing. So I will just close the bracket and that is it. So you can see for this, we've just copy and paste, right? So you can see for yourself. So this, I think it's maybe the formula is not consistent because we're using different formula. So you just ignore this. So this is it. We have our core revenue here and we have our auxiliary revenue. So the gross revenue, total revenue, you can just use the sum function. Mind you, you're picking just the core revenue and the auxiliary revenue, right? So, and you're also picking this. Wow. So we can just copy this and we paste over there. Good. All right. So we've gotten the core revenue. So we will now input it into our income statement, right? But before we do that, there was something I needed to show us when building your model. First thing I normally do so that I'll be checking the accuracy of my model is to link the three financial statements. So we're going to be linking the three financial statements, mind you. And I've done the whole formatting, but this is not cast on stone. Whichever one that fits you, whichever one you're not okay with, you can adjust it. So sometimes you can just put 2005/F, as I say, use the formatting style of years. So I can put a formatting style here, but I won't be doing it. Maybe after the whole training, we can just do a little of that. But I just want us to focus so that this training will not be that long. Let's focus on the core things we need to know when building a three-statement financial model. So one of the first things you need to do is to link your three financial statements. So as you are imputing those computations based on the assumption, you'll be checking the accuracy. You understand? At each point in time you're making any assumption and imputing on your three-statement financial statement, it should balance off. It should balance off, right? So how do we link it? First of all, the income statement, we link it to the cash flow statement by picking the net income. So you go to your cash flow statement and link it. So it's already linked, but what I did, let me just say, I didn't clean up this. So you just select this, just a minute. Let me clear all this. I'm supposed to clear it so that you see how I came about all this, right? Because I need to walk you through practically. So select this and go to the income statement. When you come to the income statement, pick the income statement for that's the net income, because the net income flows into the cash flow statement. Mind you, we start with the net income. So you can just copy and paste, right? So this is it. So we've connected the first stage. The second stage now is to connect this particular ending cash flow here to your balance sheet, right? So first of all, these ones will sum the total sum of this good. You get your net operating income, you get your investing income, your net operating cash flow, right? Have all the necessary details from the operating activity, add back your depreciation and all the changes in the working capital. Then you get your net operating cash flow. Then investing activity, which deals with fixed assets and capex, sales and purchase of assets. So you put in there and you get your investing cash flow. Financing, it's all about debt, borrowing, equity. Yeah, then you put in your financing cash flow. Then this is the net cash flow. Then the beginning cash flow. Mind you, we have our balance sheet item, right? We have our balance sheet. So the beginning cash flow, we already have the closing cash flow for that's the closing cash balance for our balance sheet. So what we'll do is to go to the balance sheet, right? So you come here, this is the beginning. You just select and go to balance sheet. I believe you're following. I believe you are. So we need the cash here. We need the cash, I think current assets. So this is the closing balance for cash because it's cash we are trying to link from the cash flow statement into the balance sheet. But we already have the cash, the closing balance for cash 2024. So we use it as the opening balance for 2025. So for us to get the ending balance is this plus, we'll do this cell plus the net cash flow, right? So that is how we get the closing balance. So you just copy this formula. Definitely, this ending balance will become the opening balance. So because this formula here now is just we picking the closing balance of what we are given because this was given, right? Why this cell definitely this other cell will pick its balance from the cash flow statement, right? So we needed this beginning balance because it was given, right? Which we now use to get all the net cash flow from the three section of the cash flow statement. We get our ending balance. So this ending balance will become the opening balance for next year, right? So you now link it. Just this is one of the key area I want you to get very well right. So this will also you now copy the formula here, control copy and control V, right? So definitely you just control copy and control V so that you notice nothing is happening. So we're still having the same closing balance, opening balance. So this particular ending balance is what will pick into our balance sheet. So we'll go back to our balance sheet and we'll come here equals to, then you go back to your cash flow statement and pick the ending balance of the cash flow, ending cash flow. That will be what will be in your balance sheet. So it needs to, you understand? Oh my God, I don't know why my shortcut is not working. So let's just control C and control V. Good. So that is how you link. This is the second thing you need to link. So the third thing now is on your balance sheet. Now, mind you that this this particular retained earning picks the net profit of the year, right? Retained earning will add previous retained earning plus the profit for the year. So you say this for you to get this, you say equals to this particular previous retained earning, then you plus the net profit that's from the income statement to go up to the income statement. So we already have 2024 retained earnings. So 2024 retained earnings plus the profits 2025. Right. So this will give us our retained earning, mind you. So retained earning of previous year plus the profit, because we've not imputed anything, you can see there is nothing it's adding up, right? So you just let's copy this, control copy and paste, right? So that's it. So let's be sure we imputed the correct figure. This plus income statement of 30th, yes, then this income statement. So we've not had that. So that is it. So you notice that we have balance. Our balance check is showing that we still have balance. So you check if assets is equal to liability plus everything. Now have it in mind that if nothing happens in the year 2025, 2026, 2027, remember have it in mind that the balances in 2024 will still be the same balances for 2025, 2026, 2027, and 2028 through to 2029. So what we'll do now is to just copy the balance, but we're going to be graying it out because these are temporary balance, right? So first of all, if I continue, I learned this from Carolina Lago. She's one, she's I think I took her course and I learned this format, and it's been helpful. You can check her out on LinkedIn. I may put her LinkedIn profile in the her LinkedIn address in the comment section. So this is one format I learned that has made it easy for you to be able to link the three financial statements and understand how they, they speak to each other, right? So I have to give this kudos to her because I learned this from her class, her session, right? So we'll just copy through the balances because we are assuming that nothing has happened before we start imputing the assumptions, so that we'll have our three statements well linked, so that while we are putting in those assumptions, we can be able to, trace and ensure that at each point in time we are, having to impute an assumption, a calculation, it balances, we link it accurately. So we'll just link the previous balance to all the years so that we'll have our balance sheet balance. So we'll just copy and you paste. But because it's temporary, we're going to still work on it. So we'll just give it a color, maybe any color you feel you can put it. So I'll give it this red color just to tell me that this, I need to still work on this. This is just a previous balance, so I need to still work on it. So for me, I'll just keep it at that red. So the same thing I'll do like this. So I'll copy and we'll also do the same thing here related to precision. Then I'll copy this and we'll paste it all through so that then we'll give it the color red. So we're assuming that nothing happened, it's the same balances we are bringing forward all through the year. Right. So this, right. So I will just also do the same thing with this, and so copy this and I'll paste it. So then remember to give it this font color. These are temporary. We'll still work on it alongside this. So come here to and we'll copy the previous balance and copy it through to all the cells. Copy and paste. Good. So now give it the color red, just to let us know that it's temporary, right? So watch what is happening. Our balance sheet needs to balance. Needs to balance. So are you seeing that? Are you seeing that it has to balance, right? So are you seeing? So we've linked the three statements. So we've linked it. You can see how we linked it. So you can see we have linked it and it's balanced. So at each point we are imputing our any computation we've made from assumptions, our balance sheet. The accuracy check is to ensure that this balances accurately, right? So let's go back to the schedule. We just computed the gross revenue. So we'll just go link it to the income statement. Remember, we have revenue, core revenue. So we have our core revenue. So go back to the schedule where we computed and pick your core revenue. This is your core revenue and auxiliary revenue. Go back to your schedule. You can use your shortcut to get this figure, so it's easier. Auxiliary revenue 150,000. So we've picked it, so you can just copy. The formulas are relative, so Control V. Good. So you can see how this links. You see the formulas are all linked. Let me clean this ones. I don't know these ones are when you put the formulas, you'll see for yourself. Good. So you can see with this, we just had only gross revenue. Definitely our net profit is. So notice our balance sheet. Is it balanced? Yes, it's balanced. Notice the cash flow statement, everything balanced because the net income, we've already linked the net income from the balance sheet to the cash flow statement and even to the retained earning. All right, so have that in mind. All right, so let's go back to the next assumption. We are done with revenue. We've picked the necessary computation. We've taken it to the income statement. So let's go back to the next assumption, which is cost of goods sold. It says raw material cost of goods sold is at this percentage of revenue while packaging. So we go to our schedule and make computation. For raw material, we say equals to, we already have our revenue. This is our core revenue, and this is our auxiliary revenue and the total gross revenue. So we'll go and pick the total from the income statement. So our raw material cost of sales is percentage. So we have the percentage on the assumption. So we'll go up. So what's the percentage for our raw material? This is it. So times, we'll have to go back to the income statement. Mind you, we'll have to pick the gross revenue here, and we'll close the brackets. All right. Okay, we're not closing the brackets. Yeah. So the same thing with this. So what we'll do here, rather than picking the, because from this 16 is raw material cost, this 17 should be packaging. So this is the cell that should be the row. We don't want the row to move. So I will just make it make the row absolute by putting a dollar sign before the row, because the column will move, but the row for the net gross revenue should remain constant. Right. So put this, and I'll just copy and I'll paste. So definitely, if you notice, this picks assumption D17 and the same thing. So your assumption D17 is what you see is just below it. So that's why we structured it very well that way, so that it can be easy. So you just sum the total, and here you go. So copy and paste. Good. So we are done with cost of sales. So we're going to pick this cost of sales into our income statement. So we'll go to our income statement, then come to cost of sales, raw material. We'll pick raw material first, and where we go to our schedule, where is our raw material, pick it one after the other, 130. Now, because packaging is just below it, you can just copy and paste, right? So you see, you can copy and paste right word. Good. So notice this is our net income. It has reduced because we have now cost of sales, both packaging and raw materials. So you can see that. Mind you, at each point, always check the three statement by checking your balance is balanced. So everything is okay. So we move to the net assumption, which is what? Our operating expenses, personnel, marketing, and SG&A. They are all a percentage of revenue. So we just go right there and pick it from the assumption. So what is personnel? Personnel is 10% of revenue. So we'll still do the same thing times the gross revenue. So we go back to the income statement and times the gross revenue. All right. Then when we come here, we'll make this cell, the row should be absolute by putting a dollar before 13. Get that right, so that we can copy this without inputting the formula again. They are all below, and we just paste. All right, so definitely this will give us this D13, D20 times D13. You can see D21, which is the cell below D20 times the same D13. You can see from the assumption sheet, this is D22. So D20, D21, D22, right? So you can just copy and definitely and paste across the other years. Right. And here we go. So you can use your Alt plus to sum, and here we go. So when you learn to use shortcut, it's much faster. Yeah. So we are done with operating expenses. So we pick it into the income statement. So we go to the income statement, operating personnel, pick personnel, take it, go back to the schedule. What is our personnel? This is our personnel. I didn't put the equal to there. So equal to, then personnel, pick the personnel. Okay. Then the next one is marketing, equals to, go down to the sheet for schedule, pick marketing. Just ensure we're picking the accurate figures so that we'll not mix it up. Then the next one is SG&A, go down to the sheets for SG&A. Then you pick the SG&A cost. Right. So having picked this, we'll just copy, because the formulas will just copy right, and There we go. Right? Good. Control V. Good. So we've gotten this, and you can see our profit is reducing, right? So the balance sheet is also balanced. We are in line, right? So let's move to the next assumption. We are done with revenue, cost of goods sold, and operating expenses. So we have our company tax, 20% of earning before tax. So go to our schedule and prepare our company tax. So company tax is this equal to um, go back to the assumption, which is pick the percentage for company tax and times it by what you have on the income statement earning before tax. So we have our EBT, then here you go. So you can just copy the formula and paste it to the right. Right, so we have our EBT, earning before tax, and this is it. So you can just take it to your income statement. And so we already have it here. Good. You can just take, I think I didn't clear the formula. So you just link it. So that's it for that. So we now move to the next assumption, which is working capital. So we've been given the previous year net revenue. I will be given the cost of goods sold for 2024, which will serve as a basis for us to compute um, the working capital. That's the account receivable, account payables, all the current assets and current liabilities with the exception of cash, right? Current assets, you've seen how we generated our cash in the balance sheet from the cash flow statement. That's how it's linked. So when computing working capital, we are looking at current assets less current liabilities to get our working capital, right? So now we have the net revenue, and we have the cost of goods sold. So we're going to be computing that, and the percentage, first of all, let's compute the percentage of our account receivable as a percentage of revenue, account payable, let's get the percentage of account receivable, that of account payable, and that of deferred revenue. So for us to get the percentage, we'll get it based on the revenue for account receivable. So it's equals to this revenue divide by, no, sorry, it's account receivable first. So you go to your balance sheet, account receivable. Where is account receivable? Go up. So account receivable, yes. This account receivable divide by, then you come back to your assumption sheets and divide by the sales, which we have here, right? Then enter. So it's 21%, 21.7%. Says account receivable as a percentage of revenue. Account receivable as a percentage of revenue, which is account receivable divided by the revenue. So 21% of revenue, yes, 21.7% of revenue is account receivable. Right. So for account payable is a percentage of cost of goods sold. So we go the same way, go to our balance sheet, go up, pick account payable. What's our account payable here for 2024? Then divide it by what we have on the assumption. Right. So what's our cost of goods? We have it here. So 33.3% is payable. 33.3% of cost of goods sold is payable, the account payable. So we'll do the same thing for deferred revenue, which is a percentage of revenue. So we say equals to, let's go to our balance sheet, pick deferred revenue, which is a liability, and divide it by what we have on the assumption as revenue. So we just divide it by 300 and 6.7%. So 6.7% of revenue is deferred revenue. So with this percentage, we're going to use it to compute, to just copy. So it's going to be the same thing all through. So we can just say this and this and this. So just it's going to be the same thing. So this is what we'll be using to compute the account receivable and the account payable. I don't know why this shortcut is not working. I guess it's because I'm recording. Yes, so I guess so. But if you know the reason, you can let me know. All right. So we've gotten the percentage for account receivable we use in computing. So the next thing for us is to go to our schedule. We need to compute it. So we'll bring in this net revenue and cost of goods sold. So our net revenue will come in here. So this, and we'll go to assumption and bring in this. So the same thing we can, yes. So we have this, we already have this net income for 2024. No, this is for 2024. We'll put it in here. This 2020, this 2025. So this net income is for 2024, and the gross cost of goods sold is also for 2024. We've already computed this. Let me just go and copy what we already computed so that we'll not stress ourselves and do it all together again. So I will just, so let's say Control V. So it's the same percentage we'll be applying. So the next thing we need to do is to also bring in our net revenue. And mind you, we've already computed net revenue for all this, for the 5 years we are forecasting. So that was what we did initially. So we go and pick it from the income statement. What's our net revenue? Our gross revenue. We'll just pick the gross revenue. Right. So 650, then what's our cost of goods sold? You go up to your income statement, pick it, total cost of goods sold. This is it. So just for us to be, so you can just, let me apply the formatting here by going to Format Painter and apply it. So you can just copy and paste. Good. Now we have all the revenue and cost of goods sold. So with this, now we can be able to compute our account receivable, account payable, and deferred revenue. So account receivable is this percentage of account receivable that we already obtained times the revenue, right? So that is it. Then for accounts payable, see this percentage of accounts payable we obtain is a percentage of cost of goods sold. So for us to get account payable, then deferred revenue, this percentage of deferred revenue times, mind you, it's a percentage of revenue, then we put it here. All right. So you can just copy and paste because we well structured it to make it easy. So we've now computed our account receivable, account payable, and deferred revenue. So we still have something to compute, and that is change in account receivable. So this is what we are picking to. Let me just put a dotted. Let me put a dotted border. Let me make it more borders. Let me use this border and just put outside borders on this so that this is what we are picking to our income statement. All right. So this particular one is going to our income, our balance sheet, so to say. Sorry for that. So let's compute change in account receivable because we'll need this for the cash flow statement because we are computing the change in account receivable. So for us to compute, mind you, when there is an increase, we need to also get this. We need to also get this. So let me pick this. Let me pick this because I was thinking I won't need it. Let's go back to the assumption pick for this year, and I can just copy and paste. Good. So we can also do the same thing. I can copy here and I can just paste it. Copy and paste the same thing. Good. So it's the same figure we have over there. So we'll just leave it at that. So this is what we need to compute our change. We're looking for change in account receivable for the year 2025. So the change is equal to the current account receivable, right, minus the previous account receivables. Now, because for current assets, these are at item we're going to be moving to the cash flow statement, right? So for current assets, when there is an increase, right, in the current assets, meaning that funds are going out, right? Money is not coming in, rather money is leaving because you are not receiving money, account receivable, your money is outside, right? So if there is an increase from 65 to, so it's going to be a minus. So what I did is just to open the bracket, close it, and impute that figure. Then maybe you put the minus sign at this, right? So because money is going out, the current year has increased as compared to the previous year. We have 140,000 as against 65,000, meaning that we are leaving our goods more outside with our customers, right? So it's a negative, it's an outflow for the cash flow statement. So you need to understand how this operates, right? So you can now copy and paste through all the other cells, all right? So that's for assets. Then for liability, you say it's the same thing, current minus the previous. So, but for liability, when there is an increase from the previous year, it means that the previous years was 30, and it means that we are not paying our liability on time, meaning that money is staying with the organization for longer. It's an inflow, it's seen as an inflow. Because rather than paying them now, you have 30,000 and it has increased to 54,000, meaning that the money you are supposed to have paid your vendors or your suppliers, you're keeping it, which is an inflow to the organization. I want you to understand it that way, right? So that's for the liability. So if it's an asset and there is an increase, meaning that it's an outflow. If it's a liability, there's an increase, meaning that it's a positive cash flow to the organization, right? So that's it. So do the same thing for deferred revenue. It's also a liability. So we say the current year minus the previous year. Good. So just copy the formulas and we'll now paste it, all right? So you can see. So this is a changes. These ones are going, let's just put the same formatting here. Let me just say the borders, okay. Let me just copy the formatting and put it here and good. So I don't know why this is here. So let me just undo. Let me leave it that way. So we know we are picking this to the cash flow statement. So what we haven't done with the working capital, let's pick it now to the respectful. So for this account receivable, we are taking it to the balance sheet. So come to the balance sheet. Where's our account receivable? Click here. So remind you, I say this is temporary. Now we have computed our account receivable. So you just put your equal to go back to your schedule. So you go down to your schedule. This is it. So you pick, mine is 2025. So you pick your 2025, which is column D, right? So you see, this is our account receivable. So I can now change the font color to black because I am done with this, right? So you can now copy and you paste forward, right? So you see we are done with that. Now notice, let's do the same thing for account payable and account. Okay, let's see for account receivable. Notice our balance sheet is not balanced. Are you seeing that? Our balance sheet is not balanced. Now go back to the schedule. Remember we have change. What's the change in account receivable? This change is supposed to go to the cash flow statement. So you come to your cash flow statement. You see where we have change in total current assets. So our only total current assets is account receivable. So you go there and pick that particular change, right? When you pick it and you copy and paste to the right. So notice. So let's go back to the balance sheet. Notice it balanced off. I think that that first step of linking these three financial statements is quite key. It helps you to be on track, right? So that is one thing I needed to show you. So let's also link accounts payable and deferred revenue. So accounts payable, you go back to your schedule, pick your account payable. This is your account payable, and I think deferred revenue just close below it. So we'll just change it to black because this is the accurate figure now. You know, we had it in red because we're not yet certain, you know, just to ensure that our balance sheet is well linked. So you can just copy and you paste. Control V. Good. Now, having done that, mind you, just as I stated, you have to go back to your cash flow statement and impute the change in deferred revenue, change in total current. So change in deferred revenue, let's go and look at it and down. Mind you, we're picking deferred revenue first, so don't mix it up. Then change in current liability, we're picking change in current liability, don't mix it up. That's account payable is all the total. I mean, I will have just said account payable. So, right? So we can just say copy and we can now paste. Good. So notice our balance sheet is balanced. So this is something I want you to take note of, right, while you are linking. So we are done with this assumption, the working capital, we're done with the calculation. Let's go to capex, which is um, our fixed assets and depreciation. Now, from the assumption, we are given that the existing useful life, the useful life for the existing assets is 4 years, and new additions, that's a new capital expenditure that was made, is refrigerator 80,000 and juicer machine 65,000, with the respective useful life of 10 years and 5 years. So this is what we require to make our computation for fixed assets. So for this beginning balance at cost, what is our beginning balance at cost for fixed assets? Let's look at the fixed assets. So we have our beginning balance, then we have refrigerator, that's the capex, then total capex, then fixed assets at ending balance at cost. So we are going to pick the beginning balance at cost. So first of all, for this column, we have the ending balance at cost, which is in our balance sheet. So we'll just go to the balance sheet and pick what we have there, what we have on the balance sheet. So remember the fixed assets, the ending balance at cost, this is the net because we took into consideration the accumulated depreciation. So this is the closing balance of fixed assets as at 2024. So we'll just pick it. All right. So we'll pick the closing balance, which is this. All right. So now with this closing balance will still be the beginning balance at cost. So we'll just link it. Now, so what's the capex? There was a capex, that's capital expenditure of refrigerator. So go to the assumption sheet and pick that assumption sheet, which is column D, mind you, 80,000 and 65,000. So the total capex, mind you, this is for total capex. So I will just use the formula. This for total capex, not including existing, just all the capital expenditure that was made that year. So I'll just copy the formula downwards. Now for the total fixed assets ending balance at cost. Now fixed assets ending balance at cost. So we have to add both the existing and the new one, right? So it's equals to this and the existing one. So this is the total assets at cost, which will be the beginning balance for this particular. So definitely we can just copy the formula downwards because there's already a formula here, right? So now looking at this, we made purchase in this year. So here there was no purchase. So just put 0, right? 0. There was no purchase. So definitely we can just drag this way because, and we can drag the formula this way. So meaning that this is the only total capex we have for this year. So we just had made capital expenditure in 2025, but the total cost of the whole assets that's at cost without taking into consideration depreciation is 185,000. Now let's look at depreciation. The existing assets is how many useful life? Let's go and pick it from the assumption. Mind you, this is 4 years useful life. Then the new assets, the refrigerator, we'll pick it from the assumption. Refrigerator is 10, so we have to pick it, then you can just copy because this one is closed. So this is a useful life. So looking at this, we can now compute the depreciation, total depreciation. We have existing and we have refrigerator for the new assets. So depreciation existing assets, let's look at for this particular year. Net assets in the balance sheet. So go back to the balance sheet, pick this net assets, right? And lock it because we just need the net assets, lock it and divide it by what we have in the schedule. You see this 4 here. We'll also lock it by putting 4, making it 4. So it's going to be 8,000 because it's remaining 4 years. So we can just for the remaining 4 years, I think 32,000, we are done. So this 4 years is on the net assets of the existing capital. Mind you, they see the useful life, the remaining useful life is 4 years. So you apply it on the net assets. That's the total cost less the depreciation, which is what is on the balance sheet, right? So have that in mind, and that is how we came about this. Then for this new assets, mind you, We already have it, and they're giving us that this has 10 years useful life, 5 years useful life. So we'll just say this, we'll lock it by, because it's just straight line depreciation as we stated, and divide by this straight line depreciation, right? So the same thing with this for the juicer, lock it and divide it by the number of years. We'll also lock it because we don't want it to move across. So good. So we have total because it spans across. So I'll just use this fill handle to copy down words. So that's it. So having gotten this, we'll just sum the total to get our total assets. Total depreciation, sorry, total depreciation, then you fill right words. So this is the total fixed assets, right? So you can fill this. Good. So this is the total assets as cost. This is the total depreciation, right? This is the total assets as cost, and this is the total depreciation. So we'll go back to, we'll link it now to our balance sheet. So the balance sheet for the fixed assets at cost. So you put your equal to and go to your schedule and pick this particular assets total at cost, right? So why the accumulated depreciation? So we are picking the accumulated. Mind you, this is accumulated depreciation, not depreciation. This is what accumulated depreciation. So if you go to the schedule, you will notice something. This is depreciation for each year, right? Each year's depreciation. So for us to get the accumulated depreciation on this balance sheet, what we'll do is the equals to the previous year's depreciation plus, then we now go to the schedule. Then you now impute this current year depreciation, right? And that is it. So we have it here. Then you can now change the font color to black, then fill to the right this way. So we have our depreciation, fixed assets, total fixed assets, and accumulated depreciation well computed. Now, notice our balance sheet is not balanced. So we still have to make some entry. Now, we have to go to the income statement to capture the depreciation elements. So go to the income statement. Mind you, this is it. So you come to your schedule, and what is the depreciation? This is the depreciation, total depreciation. So you just copy and paste. Right. So this is it. Let's look at our balance sheets. Yet it's still not balanced. We still have one or two things to do, which is the cash flow statement. Remember, we have capex, we made purchase, right? And we also need to add back depreciation, right? So remember the depreciation. So you come here and go back to your income statement, pick that depreciation you have imputed here, pick the depreciation you have imputed here. You can copy through to the end. So you add it back. Then remember your capex, you made some capital expenditure. You go back to your schedule. Remember capex from this month, you can just total. You can just put the total here. I think the total is total capex. Yes, this is total capex. So you can now fill this way. Good. So let's see if our balance sheet balances. Oh, it did not balance. So what's the problem? Let's look at it. Yes, let's look at it. So we still have 348, 408, 464, 522, and 564. Right. Okay, so what's happening? Let's look at our balance sheet as I stated. So we still have our balance not balancing, right? Our balance is not balancing, so something is wrong. So let's go to the cash flow statement. Mind you, this capex is capital expenditure, meaning that money leaving the organization. So it's supposed to be minus, all right? So put minus, and maybe we'll fill to the right, copy fill to the right. Good. So let's look at our balance sheet. It's still not balanced. Okay, so what's the challenge? Let's look at it. I think there is a problem with this formula here. So let me just impute it the way I would have done. So this is minus, then minus this. Yes, it's supposed to be this way. So we minus this particular, this is already positive, so we'll put it in minus. So minus minus to add the total. I think it should work. Yeah, good. It works. So we just copy, fill it to the right, right? So that's good. So we are good to go. So this is why we need to be checking. Most times our formulas can, can just mess us up, and not linking it where we need to link it. Are the three statements as they speak to itself also can be of that. As you can see, we're able to fix that. So that's it for the depreciation schedule. So the next is the debt computation. So let's go to the assumption for debt. So the debt says new borrowings is 300,000 in 2027, and the repayment is 10,000 for previous debt and 30,000 for the current. So definitely we needed to add the previous and the current because it's still reading, right? So we'll go to this and pick it, our opening balance. I think the closing balance is what we have on our balance sheet. So let's go back to our balance sheet and pick that closing balance. What is our debt? Our debt is this. So pick it here, right? As our closing balance, which is definitely going to be our opening balance, right? So what's the new borrowing? Do we have new borrowing? Let's check. Go back to your assumption. New borrowing for column D. Okay, so we can just copy all through down. Then repayment, I guess we do have repayment, so we can just copy all through down. So what's the formula we are using? Is equals to the opening balance plus new borrowing, then minus repayments, right? That's the formula. Good. So you can just fill downwards. Then you can also fill rightwards, rightwards. So this is it. So these are our debt repayment, and this is our closing debt. So we'll now have to, so we need to have our interest expense calculated. Mind you, we have the interest expense percentage as does the rate 7%. So our interest percent is, we apply it to the closing balance. So equals to this times the interest percentage. You go up and pick the interest rates, and there you go. So that is it. So we can just fill to the right, and we are done with this. So we can link it back to the balance sheet. Let's go back to our balance sheet. These are debts. So go closing balance, go back to the schedule and select the closing balance. Good. So mind you, we'll have to change the color to black because we've now gotten the right figure for this. Good. So I will see having balance. So we need to go to the cash flow statement and debt repayment. So we'll have to go back, schedule. What's our debt repayment? Let's pick it up from here. And good. So we can just copy to the right. Copy to the right, and that's it. Then new borrowings. Do we have new borrowings? Yes, we do. So we do have new borrowings. So let's pick the new borrowings from column D, and we'll copy to the right. Good. So now we have debt repayment. Mind you, this debt repayment, remember, you have to put negative positive because money is going out, you're paying back your debt. So we have to put negative here. Yes, because the debt repayment. So we can now move it to the right. Good. So new borrowings, money is coming in, so it's positive. So I think we're good to go, right? Yeah, good. We're good to go. So our last assumption is on, I think let's look at it says on equity, there was no issue, no new issue or repurchase of common shares, that's ordinary shares. So there was no new issue and there was no repurchase. So let's go to our schedule. I think there's no new issue. So opening balance, closing balance. So our closing balance for equity, which is our, we'll go to the balance sheet. This is ordinary share. So this is it. The closing balance, which is going to be our opening balance. Then new issue, they say no issue, no new issue, there's no repurchase, it's closing. So you can just say equals to opening balance plus new issue, that is, we're going to raise more fund, then minus if you're selling out, if you're repurchasing, that money is going out. Right. So You can just fill the formula to the right. Good. So now our balance still remains the same. So to link this to this area, so there was no new issue and there was no repurchase. So we can just link it back to this place and there we go. I think that is it. Good. So you can change the color. We are done with it. We've gotten the accurate figure and you can now copy formula to the right. Good. So we can see we have built our three statement model. All right. We have built our three statement model. So everything is balanced. Everything is balanced. So mind you, we just have some metrics we want to get to know. Gross profit margin equals to gross profit. Let's just do this. Gross profit. Where's our gross profit divided by gross revenue? Just a gross profit as a percentage of your revenue, right? So that's the 75%. And net income is equals to, just go to your net income as a percentage of revenue just to see how your the metrics, how you're going, and divide by the gross revenue. And that's it. So you see, 44% of our net profits of our revenue, we made 44%. Then gross profits is 75%, meaning that we quite spent like how many percentage on all the expenses and stuff like that, right? So you can just fill to the right, and there you go, and that's it. So other editing you can do if you so wish. So like this, I was saying that you can just put a formatting. You can come here and you use this formatting style. You can just come here and put slash for a forecast. F is for forecast, so you can just put F and that's it. So it will put F in front of it just for you to know if you so want it and there's no ESV. So let's just put the format and say okay. So that's just it. You can replicate it to all the cells. So this is just for by the side. But the major thing is for you to know how to build a three statement financial model using this case scenario. I believe we've gotten value and I would like to hear from you. Were you able to go through this process? I know this tutorial is a long one, but it's packed full with value. So go through it, give your just test it around. You may not get it the first time, but don't be discouraged. Give it a try again. Let me get to know your experience in the comment section. Let me know if you've gotten value from this tutorial. Right. So thank you for staying through this training, and I hope to see you in the next lesson. Right. So do well to like this video, share with as many that you know that will get value from this, and hit the subscribe button and the notification bell to get notified whenever I upload value tip on this channel. Thank you, and I'll see you in the next lesson. Bye for now.